Hello, and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like Wisconsin to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing how to move your existing limited liability company or corporation out of Wisconsin to a new state to avail yourself of tax benefits, among other advantages. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, Wisconsin is not the worst place to live, and it is not the worst place to conduct business, but it is far from the best. Wisconsin ranks in position number 21, that's 21st on the Tax Foundation's most recent state tax competitiveness index, placing it in what I call the mediocre middle. The ranking reflects a state that has built 2 of the best tax components in the country, sales and property, but has paired them with 2 of the worst, individual income and corporate income. Wisconsin is a state at war with itself, at least in terms of tax and fiscal policy. The state sales tax ranks in the top 10. The combined state and average local rate is among the lowest in the country. That is a good thing. We will give them credit for that. The base is uniform across state and local jurisdictions. Administration of the sales tax regime is centralized at the state level. Wisconsin repealed the tangible personal property tax in its entirety, which is a good thing, eliminating a tax that many states choose to retain. The property tax is constitutionally required to apply uniformly across all classes of property under the so-called uniformity clause of the state constitution, meaning commercial and residential property are assessed at the same ratio. That is another good thing, meaning there is no so-called split roll, and there is no state level estate tax, and there is no state level inheritance tax, all positives. The public pension system in Wisconsin is overfunded at 102%. That is also a good thing. So, on the sales, property, and public pension metrics, Wisconsin is a good place to be. Now, the individual income tax erases those gains and then some. The top state marginal individual income tax rate is almost 8%. That rate is high both regionally and nationally. Indiana is at 3%, while Iowa is at 3.8%, and Michigan is at 4.25%. Even Illinois is lower at 4.95% flat. Wisconsin is higher than every neighboring state that imposes an individual income tax, except Minnesota, which we covered on an earlier presentation. The Tax Foundation identifies Wisconsin as one of the only states that has cut income taxes in recent years, but stopped short of reducing the top marginal rate. So it's really not much of a cut at all. The state legislature reduced the lower marginal rates, which benefits taxpayers in lower brackets, but does not benefit business owners because it did not reduce the rate that applies to pass-through business income above the top bracket threshold. The rate that matters most to business owners is the rate the legislature chose not to cut. The so-called marriage penalty in Wisconsin's individual bracket structure is only partially offset by a married couple credit, which, if that sounds complicated, it is, and unnecessarily so, I might add, which the tax foundation describes as an imperfect solution that adds to the tax code without addressing the underlying problem. Typical politicians. A credit that compensates for a penalty is a quick patch, not an actual fix. Now, let's talk about the corporate income tax. More bad news here. The corporate income tax rate is 7.9%, which is above the national average and above every neighboring state, again, with the exception of Minnesota. Wisconsin imposes a so-called throwback rule on corporate income, taxing out-of-state revenue earned by Wisconsin domiciled companies when the destination state does not tax it. That is extremely unfavorable for business owners, particularly owners of small and medium-sized enterprises. The state does not offer first-year expensing for capital improvements. Again, another major deviation from the Federal Internal Revenue Code, which penalizes small and medium-sized business owners especially. The tax foundation states that these two provisions combined expose an outsized share of in-state business income to the almost 8% rate. Again, a lot of problems here. Hopefully, you are getting the theme. A company selling products into multiple states from a Wisconsin headquarters finds that income in states that would not be taxed, for example, in Florida or in Texas, Wisconsin steps in and taxes it anyway at the full 7.9% rate. And the capital investments that the company makes cannot be deducted in the year of purchase, unlike most other states. Federal Internal Revenue Service migration data show that Wisconsin is one of the top destinations for residents leaving Illinois. That is an interesting nuance. That inflow reflects the fact that Wisconsin is better than Illinois, which ranks in position number 38. It does not mean that Wisconsin is competitive with other states like Florida or Texas, where no individual income tax is imposed. The residents leaving Illinois for Wisconsin are trading a 5% rate with a proposed surtax to almost 8% for a 7.65% top marginal rate, probably not worth the migration. On pass-through income above the top bracket, they may actually be paying more in Wisconsin than they were in Illinois, which makes you wonder who was giving them this advice in the first place, but that's another topic for another presentation. State and local tax collections per capita in Wisconsin are $5,953. And state and local debt per capita is a little high at $9,241. To put all this in perspective, on $500,000 of pass-through income sourced to Wisconsin, the 7.65% produces almost not 14, but $40,000 in annual recurring state income tax. If you were in Florida, that number would be zero. If you were in Texas, that number would also be zero. Over 10 years, the difference is almost $400,000, and that is before we account for the time value of money. That's enough to buy a house in some places. Now, with that background in mind, let us shift gears and get to the core of today's presentation, which is the topic of redomestication. Redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income taxes, but only when performed within the strict requirements of the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. This is not a DIY weekend project. When executed by a competent, keyword being competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts, which is to say there is no operational or financial disruption. Now, foreign entity registration is not the same thing as redomestication. Do not allow yourself to become confused. Foreign entity registration does not change the company's domicile. It does the opposite. It keeps the entity in Wisconsin indefinitely and merely adds a second layer of tax and compliance obligations in the destination state. It is an expansion mechanism, not a relocation mechanism. Meanwhile, a traditional merger, which is also not the same thing as redomestication, establishes a new distinct entity in the destination state and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all unless the company is going out of business. Dissolution is a termination mechanism, not a relocation mechanism. So if you have a so-called professional recommending dissolution as an avenue for relocating the company to a new state, please get better advice. Redomestication, when paired with a change of personal residency, and this is an important and a reduction or outright cessation of business operations in Wisconsin can reduce or even eliminate state tax exposure for the entity and its owners in that state. Now, to recap, Wisconsin has a top 10 sales tax, a constitutionally uniform property tax, and a well-funded public pension system, but it also has an almost 8% top individual rate and an almost 8% corporate rate with a nasty throwback rule and with no first-year expensing. The writing is on the wall. There are better places to domicile your business. The good half of the Wisconsin tax code does not offset the bad half. Now is the time to consider acting before the Wisconsin legislature changes the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of Wisconsin or out of another state, please use the link in the description for more information on this nuanced process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information informative. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for that consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.